Okay.
Okay.
All right, so I will admit everyone. Okay.
Okay.
All right, sounds good. Hello, everybody. Welcome. Welcome to everybody joining. Greetings to all of our alumni and friends here. My name is Greg Leparati. I'm Associate Director of Alumni Relations at Baruch. So glad you can be here with us tonight. The Office of Alumni Relations has been hosting a lot of events like these, career-focused, as well as panel discussions and other things virtually, since we can't meet on campus. These have been wonderful. We've really enjoyed having so many alumni connecting with us and being here for so many great webinars. I'd like to also thank Alan Grodin, who is going to be presenting today. I asked that everyone try to keep their cameras and microphones off during this presentation and direct your questions to the chat bar. And we will try to address as many of those questions as we can throughout this presentation at the end. And with that, I'd like to now introduce Janet Rossback, our Director of Alumni Relations and Volunteer Engagement, who will introduce our speaker.
Good evening, everyone. I hope you are all safe and sound and feeling well. It's been a long week of a lot of rain and gray where I've been, and I really am looking forward to this evening's program where we will talk about money and mindfulness, things that we both can benefit from for sure. I have known Alan Grodin for several years now. We participated in a workshop together maybe about 5 years ago and have kept in touch. He is an experienced wealth manager and also an active mentor in our Executives on Campus program. And when he approached me to say, I'd love to talk to you about two things that I spend a lot of time thinking about, both money and wealth management, and how to remain mindful in life as well as about money, I thought it was a winning combination. So this evening, Alan will give a brief presentation about his philosophy on money and mindfulness. And then we will open it up to you all to ask your questions. We are scheduled to run from 6 to 7. We may go a little bit longer depending on questions. Alan is very generous with his time and his advice. So as of this moment, we have a poll that says 20% of our participants are between 22 and 30 years old. 59% is in the 30 to 50-year-old range, and 16% is in the 50 to 65 range, and 5% is in the 65% range. So Alan, I think we have a group of ambitious, mature, and professional alumni with us this evening. And with that, the floor is yours.
Okay. Can you hear me okay? I guess that's the first question. I'm coming through all right?
Yes, very much so.
Welcome, and thank you very much for coming. What I'd like to start off with is how this talk came up. About 3 years ago, I decided to retire. And in my 40 years as a financial advisor, it never ceased to amaze me how much bad thinking there was about money from otherwise successful and intelligent people. It just always amazed me. And I decided to spend the 2 years before retirement reading about it, getting a handle on it. And what I'm going to talk about, in addition to what's on everybody's mind, which is the effect of COVID-19, is those findings. First, what happened? Let's talk about what happened. Before COVID, things were running beautifully. We in the investment market, we were thinking that it's possible that we might have a correction, but we weren't afraid of it. We thought it'd be minor and quick and out there. Then two events happened simultaneously. One was well known, which is the COVID-19 virus, and the stoppage of work and isolation and all these other factors. But at the same time, there was a flood of oil into the market, drawing prices down. And that wreaks havoc with the market. In the long run, low oil prices are great for everybody. Your food costs less, your driving costs less, but in the initial hit, it's disruptive. So what happened was the market went, and I'm going to be quoting the Dow because that's the most famous, most widely used, I would say, went from about 28.5 to 18 in a couple of days. Frankly, I thought it was not bad considering those two events. Today, if we look at the market, it's about 24, 25,000. And I think we've reached, at least in New York, I know there's people from all over the country and some from all over the world. In New York, I believe we've hit the maximum and we're on the downwards spiral. And that's where we are today. The difficult part, of course, is making a prediction about the future, which nobody knows for sure. But I'll give you my opinion. My opinion is we are vulnerable to another dip. That wouldn't surprise me at all. But when the economy gets up and running, I think it's going to be a sharp increase in the marketplace, and I'm very optimistic about the near future. Most of it due to the government programs, which I now understand are being duplicated in the European market and in the Japanese market, the flood of capital. And a part of this incentive is that these are loans, which unless they're used for payroll, must be paid back. So there's going to be tremendous encouragement for everybody to get back to work. Good thing. So that's my take on where things are and where things are going to go. And now I'm going to talk generally about money and investing and behavior. But before I do, I'd like to indulge upon everybody for a short meditation. What I'd ask you to do is sit back, close your eyes, and with your feet on the floor, and think about your feet, and think about making your feet relax. If you don't, just have that intention. And whenever I mention a part of the body, I'd like you to just think about relaxing it. And we're going to start with our soles, move to the ankle, and think about relaxing that. Think about the calves, and think about relaxing that as well. Now the knee, and think about relaxing your knee. Now your thighs, and think about relaxing them as well. And now think about your waist. Think about relaxing that. Your chest. Think about relaxing your chest. Your shoulders. Think about relaxing those as well. And think about going down to your bicep and relaxing that. And your elbows, and think about relaxing your hands. Now, think about your neck, and think about relaxing that. And we come up slowly to the eyes, and think about relaxing those. And when you're ready, open your eyes, and we'll resume. Okay. Now I'd like to talk about why investing has become such a difficult topic. And one observation I've made is that if you go to a party, it's perfectly acceptable to say, what kind of work do you do? That's a perfectly normal question. But now, imagine you say to that same person, how do you allocate your savings? That's a faux pas, and I'm not sure why, but we don't talk about it. It's a secret. And if we're uneducated, we're vulnerable to the media. And the media has one goal and one goal only, and that is for you to watch as often as you can or read as often as you can. And the only two ways to do that are to get you excited or upset. And with that, I move to the next slide. This, I think, is the ultimate definition of mindfulness. The space between the stimulus and the response is where growth and possibility and freedom lasts. I had a friend call me and ask me for advice on the market when the market went down. And he said, well, I lost $200,000. And I said to him, well, you didn't really lose it if you didn't sell. And he said he sold. And that was just a reaction. It wasn't based on logic. And at times like this, the most important thing is to act mindfully, not to act on stimulus. And that's the most important thing we do. I think a lot of it has societies also, because I know I was told a lie when I was starting out, and this was in 1975, and I think this lie is still being told or suggested in society. And that lie is, if you make a lot of money, everything will take care of itself. And you only have to look at sports reporters, sports figures and artists to see people go through millions of dollars easily and end up bankrupt. And I have to tell you, in the business world, it's not a whole lot better. I actually met a 50-year-old CFO of a mid-sized company who was heavily in debt with no investments or savings. And I think it's because it's such a secret in our society, where our careers are way open and we're encouraged and we can talk about them freely. Nobody will talk about their investments. It just doesn't happen. With that, I want to talk about a video that I saw, and you can switch the slide to that video if you can. Oh, there you go. Thank you. And this is a video that you'd find on TED. This woman is 55. She's a graduate of the Harvard Business School. And she's unemployed and broke. And she will tell you that it was from excess spending and bad decisions. So she was encouraged in her life to believe that her career was all that was necessary. And this is something that proved not to be true. And it's something that if you take a mindful approach to things, you can avoid very easily. And the other part about this is not a new problem. This has been going on through history. As a matter of fact, Thomas Jefferson, one of the founders of our country, offered his slaves that upon his death, he would free them. But when he passed away, he was so heavily in debt that the slaves were auctioned off on the lawn. Now, you can decide whether he was clueless or devious. But in any way, here we have somebody that was able to, was a founding father, well-regarded, ran a business with slaves, so no cost of employment, and still managed to be broke at death. So that to me is a very interesting fact. Let's go to Ralph Waldo Emerson. There we go. There's basically three reasons why we buy stuff that I'm aware of. One is Madison Avenue, which is the advertising business, which tells us stuff. The other is social pressure, which is enormous. And the other is something you truly want and something you truly enjoy. I think it's a great idea to take that moment between stimulus and response and consider that in every time. I recently bought a new camera system, and but while I was doing it, I really wondered why I was doing it. Was it to take better pictures and get more into the hobby? Was it because Nikon told me that my life was incomplete without it? Or was it to show off to the people at the photography workshops I go to when they really say to you, what are you shooting with? So I would be shooting with the new stuff. That's something for us all to consider when we make purchases. And I think it's very important. You won't fully defeat advertising or social pressure, but you can put up a very noble fight and improve your life this way by simply not reacting to stimulus and waiting and thinking out your response. That's where you can do something. Marie Kondo wrote a book about the joy of tidying up, of getting rid of things. It would be a great life if we didn't have to. And this is not easy. In fact, it's a lifetime job. I would go to Epicurus now. And it's a lonely process. It's not something that we talk about in our conversations or that is the media is talking about. This is our lives. And there's only two rules that you have to follow to be successful at this. One is to pay yourself first, and the other is never, never to incur credit card debt. If you do that, you become their slave in 10 or 20 years, and it consumes you. And unfortunately, I've seen it too many times. So if you are in credit card debt, my advice to you is simply to consider that it is now your ultimate responsibility to pay it off as quickly as you can. Keeping score. Now, I did a little experiment with a daughter of a client of mine, and I asked her to download her credit card statements and analyze them in three categories. Think about the word new, N-E-W, need, enjoy, waste. Now, you can put that slide up right now. There we go. And this woman had no problems. She had a nice job, she had good savings, but she noticed in every bill that there was waste. And her response to me was, I could take another week's vacation with this. And I just have to watch myself and be aware of it. So if you ever look at your credit card statements and say, what happened? Now I know the times we're in, I don't know if most of us, our credit card statements have gone down dramatically. Not eating out, not going to shows, little entertainment bars, none of that's happening. But you can look back at January, February, and March and take a look at it and see what the progress is. So that's something you may want to consider. Need, enjoy, and waste. Think about what you're doing when you do that, when you're making a purchase. Am I doing something I need? Am I doing something I enjoy? Or am I wasting? Waste comes in many ways. There's the Starbucks issue, where on a given occasion, Starbucks is fine. But if you do it every day and buy the most expensive coffee, when there's a coffee machine at home and there's a coffee machine at the office, you're wasting. And I think with drinking, a lot of people are wasting. Not that I'm opposed. I happen to enjoy wine a lot, but I mostly drink it at home with friends. But let's now go to investing. And I think there were three valid ways of, I call them sane models of investor. Because before you look at any investment, you have to understand yourself. The three ways are alpha, index, and beta. And I'm going to expand upon that. The alpha investor wants to get the maximum return. They fully understand that when the market goes down, they're going down with the full force of it. But they figure that 70% of the time the market's up, and they'll wait through that. They were the true alpha investor was unfazed by the drop. So they will just continue and they will be fine. The index investor is the one that has the least interest in the market. They are going to get what you hear on TV. If they best invest in the S&P, they're going to get it. They're going to pay the minimum fees. These are very inexpensive. You can buy an exchange-traded fund, or you can buy an index mutual fund, and you can do it and consistently build it, and you'll be fine. And there's a beta investor. The beta investor is concerned about downside risk. And as we get older, as I am, I have to be a little concerned about that. And the beta investor wants to participate in the market, but have some protection on the downside. They understand that when the market goes up, they're not going to get all of it, but they're going to get a good return. And when the market goes down, they're going to go down less. You, the investor, should identify yourself in this way so that you'll be confident going forward. To me, this is very important. Most people haven't thought this through. What is your personality? And by the way, you can be a beta investor and have 20% in alpha. But if you're uninterested and don't want help, I think indexing is fine. Once you make that decision, do not change it unless your situation changes dramatically. Don't ever react to the market. It will do what it will do, and it generally goes up. Give you some statistics just to, over a 5-year period, historically, if I take it from 1900 to today, and I take all the 5-year periods and add them all up, the market's up about 75% of the time. If I do it over 10 years, it comes to 98%. And we actually lived through one of those 0 times. But 98% of the time, over 10 years, the market goes up. You move it to 15 years and you're at 100%. So the only thing, if your time frame is more than 15 years, the only thing stopping you is your emotions. And if your emotions are conservative, that's fine. You'll be okay with that beta investing. There's nothing wrong with it. The problem will be when some people react to the market and are alpha in the good days and beta in the bad days. And they lock in losses and they become very dispirited and very unhappy. And I've seen this happen many, many times. And I want to tell you something that actually happened. And let's go to the Tesla slide. This really happened. And if you look at this point on the market, does everybody see that I just did with my mouse? Which was around the end of this year. A money manager who I totally respect suggested on CNBC, and that Tesla was a great long-term investment. And I'm sure that a lot of people on that call bought Tesla and felt that here was the best money manager, here was their best suggestion. And what happened to Tesla? It declined about 35%. And I'm sure this caused the people who look on a daily basis tremendous despair, unhappiness, and they sold and they gave up on equity investing. But then what happened to Tesla? You look at it on this chart, because the chart was done a few months ago, it went up to 580, more than doubled. And if I look today, it's close to 800. I don't know whether it's a good buy or not, but when you make an investment, you're buying a company. You're not buying something that's going to change every day, or it will change every day, but that's not important. You've got to look at it at least 5 years out. And that, I think, is the best advice. For active management, I think you need an advisor. I haven't seen people do good choosing active management or doing it themselves. For indexing, I think they can do it on their own. There was a book by John Bogle, and he had you buy 3 index funds. The US, the international, and bonds. Now, bonds are now very, very dangerous, and I'll talk to you about that a little bit. And here's a place where empirical analysis doesn't work. People have been making money on bonds for years because the interest rates were going down consistently. And that caused the bonds, in addition to the interest rate, the values to go up. And people got locked in. This is a great thing. I'm not taking any risk. I got a 6% coupon and I got my bond went up 5%. This is a wonderful investment. But where are we today? Interest rates are hovering close to 0. So the return on the bond you're going to get is not going to be significant. And the danger of that bond is going to be significant, because when and if interest rates rise, those bonds will be destroyed. So a couple of basic truths, and then I'm going to open it up to questions. Investing is not entertainment. The media has one and only one goal, is to keep you watching TV and buying newspapers. The way they do it is to appeal to your base emotion of fear and greed, which are your 2 biggest enemies in investing. Investing takes a bit of intelligence and a lot of discipline. What I'd also point out to you, and what I've left out, is that the stock market is not the only place to invest. I've seen successful people invest in real estate of all different kinds, commercial and private, and do very well. It's a lot more complicated. If you do that, your potential is every bit as good as in the stock market. But you will need an attorney and a very qualified accountant to help you along this road. And if you do opt for that, you have the ability to do well in the real estate market. I just don't know that much about it. So that's why I didn't spend a whole lot of time, but I want to make that aware to you. I compared today to 1975 when I got started. I actually had to get dressed to spend money. I had to leave my house, go to some place and spend money. You folks can do that from your bedroom, and you have access to your credit cards up to the minute. You have access to your checking account up to the minute. I had to wait for a month to get my credit card statement. I had to wait a month to see my checking account. Checking accounts, credit cards were just beginning. So you have And for you, and mutual funds were just beginning at that time, you can start investing with tiny amounts of money in mutual funds. You can watch it, you can market it, you can look at it. So you have more, if I put it down to its minimum, you have more opportunities and more dangers. So I hope I've given you some guidance going forward on how to approach that. In the short, thank you. We'll end with that. This is Benjamin Graham, who was Warren Buffett's professor. In the short term, the market is a voting machine, but in the long run, it is a weighing machine. Short term, we don't know what's going to happen. But if we buy good stuff, we're going to be fine in the long run. And that's where I'll leave it, and I'll take questions as they come.
Thank you so much, Alan. I have a handful of questions already coming in, and encourage folks to continue to post them to the chat box. The first question is the following. Given the amount of fiscal spending, what are your thoughts on inflation down the line?
Good, great question. A risk, definitely a risk. Not short term, but long term. Meaning a lot of this fiscal stimulus is in the form of loans that can be paid back. That's not inflationary. However, there is a lot that's being given away, and I do think inflation is a danger, which should move you away from bonds into equities, because equities have been shown to keep pace with equities, and again, I have to say real estate as well, keep pace with inflation. So I hope that answered your question.
The next question is, which areas do you see as undervalued and hence a good opportunity to look into today?
Good question. Okay. I still think, and again, it's not undervalued, but I still think it's the best. And there's something called the value trap. Sometimes things are cheap because they should be cheap. So because they're cheap doesn't automatically make them good investments. Oil companies, I'm afraid of that. They're down, they look cheap. I'm still afraid of them. I do like technology. I do like biotechnology. I like, in other words, I don't like banks, because I think that there's financial technology that's going to make them obsolete. I think there's great disruption in the marketplace that we are. Meaning there was a long-term, and again, these are old rules that somehow kept going. Buy blue chips and you'll be fine. Has anybody looked at GE lately? That was one of the greatest companies 10, 15 years ago. And it has really fallen on hard times, and I don't see it coming back. So what I'd add, it's better to buy, and again, this is a Warren Buffett thing. It's better to buy a good investment at a reasonable price than a bad investment at a very inexpensive price. So think, price value is a consideration, but it shouldn't be the only consideration.
What are your thoughts on healthcare or pharma stocks today, especially as everyone is chasing for the COVID-19 vaccine?
Here's the thing, and it's very difficult because there's going to be winners and losers. If you think, looking back, everybody would love to have bought Starbucks at the beginning. That would have been if I just bought Starbucks when it started, I'd be doing great. But what you don't realize is that there were 5 companies vying for that same place. Starbucks won. So in addition to pharma, now if you buy the index, you're going to be fine. But if you start to cherry pick, you better be good at it, because you could buy a loser. So in general, the biotech area is very attractive, but there will be losers there. So just beware of that.
We have received a request. Can you explain why bonds are not a good idea now?
Okay, now I wouldn't say completely. I would say long-term bonds, if you understand how a bond works, it pays a coupon, a percentage rate, and then it vacillates till maturity based on the current interest rates. So with the danger, first of all, your coupon is low. Long-term bond is now paying about 2%. So you're going to lose against inflation, and if the interest rates do go up, which is a real possibility, you're going to lose principal. So that's now if you take 5-year bonds and you ladder them 5, 4, 3, 2, 1, you won't get much, but your money's going to be protected. So I wouldn't say with a never buy a bond, it's not a good idea. You could, but I would only use the intermediate term to the short term as a safety net, because otherwise you're too vulnerable to the possibility of rising interest rates and you're not rewarded for it.
Thank you. Do you think when we surveyed what sort of investors folks imagine themselves are, one person said, I'm an index investor, but I wish I were a beta investor. Can you give any counsel on how to protect one's money at this point in time?
Yes, what I would do, and if you're that way, I would build my cash cushion. Meaning I would continue, I think there's nothing wrong with the index investor, and you'd like some protection, build a cash cushion. If you want to buy a CD 2 or 3 years out for a couple extra points, go ahead, but essentially your cash is your protection for the indexed investor.
And what if you don't have that cushion today?
I would be building it.
Okay.
Meaning, before I invest, if you're completely starting out, the first thing you should do is build a cash cushion that makes you comfortable. 3 months, 6 months, that's something for you to decide, but build that cash cushion before you invest.
So when you say 3 months, 6 months, so that you can cover your expenses, all your expenses for 3 to 6 months.
Yes, meaning, and whatever makes you comfortable. So, if that index investor wants to build a bigger cash cushion, go ahead. That's your protection. You're not going to get much on it, but you're going to be protected. Now, let me go a little bit step further in that there are asset classes that are hybrids between bonds and stocks. And you can buy the indexes on them. These are preferred stocks, high yield bonds, and convertible bonds. These things will not go down as much as the market. These are beta bonds, meaning these will give you somewhat of the participation in the market, and they will give you some return. So those for the indexed investor, I might look at those and consider them.
Thank you. We have another question here. What is the difference between a money market account at a bank and a money market mutual fund?
Very little. They're really, in today's market, they're paying so little that it almost doesn't matter. They're both liquid. And, one of the problems that we have is if you go back to 2008 and 2009, a couple of money markets broke the dollar, meaning went below $1 in value. And that caused the regulators to make them even stricter and caused the yields to go down even further. So there's always a side, how can I put it, unintended consequence to any action. They were trying to protect the consumer. They also brought down the yields of the bonds, of the money markets. but there's a very small difference between those two. Not significant.
Okay. And what about buying funds that short the market?
Dangerous. There's funds, by the way, there's ETFs and funds that will multiply the market 2 times or 3 times, and they'll do it in reverse, and they'll short it 1 time or short it 2 times. Be very careful with that, because they do what they say they're going to do, and if it works against you, it's going to be dramatic.
Yeah.
So I'd be very careful there.
So a slight shift of the conversation. We have a question about buying homes and another question about paying off student loans. So
Sure.
on the housing market, would you say that now is a good time to buy a home?
I just bought a condo for my daughter.
Wow. Okay.
So yes, if you find something that you like, you're probably going to get a discount for it. But is your down payment down as much as the real estate's down? So if it's in cash, yes, that's fine. Meaning, I think it could be, but again, look at it clearly, and mortgage rates are incredibly low. So yes, I would say if you find what you want, yes, it could be a very good time. Okay. But you have to inspect the house with a mask on.
Right.
And you have all these impediments that you just have to deal with the COVID virus.
So is there incentive to sell stocks now to build a bigger cushion so you have greater cash for a down payment?
Well, that very much depends on the situation. Market isn't in bad shape. Again, I'm more optimistic, but if I was buying a house, well, for instance, my son, who's an incredibly aggressive investor, is buying a house. He put everything in cash and low-risk investments. So I think that's something you got to do way ahead of the process if you're looking to build that down payment.
And we'd like to know, how long does your crystal ball predict interest rates and mortgage rates are going to remain low?
Predictions are very difficult, especially about the future. My guess is we're going to have at least a 6 to 8 month honeymoon before this happens. The government does not want them to go up. And if you say they will go up, I do believe that. Will they go up shortly? I don't think so. You also have to realize with real estate, in the same fashion, there's an inverse relationship, because if the interest rates are up, the prices will go down. And so it almost doesn't matter. Yes, I think you're getting a good value today, a better value today than you did 6 months ago. But when things return to normal, if interest rates go up, the prices will go down. You'll end up paying the same amount.
Okay. About student loans.
Yes.
We have several graduating students on the line and recent grads.
Very good question. Very good.
How best to pay those off?
Well, I look at the interest rate, and if it's below 5, I want to pay them off slowly. If it's above 7, I want to pay them off aggressively. So I look at the interest rate and I say, is that a hurdle that my investments can outperform? And a 3% hurdle, long term, I'm very optimistic about that. 5%, okay, I'm still optimistic. 7%, I start to get worried, because it's a guaranteed return as opposed to an unguaranteed return. So I would look, now most of these, just so you know, I don't know if you're aware of this, once you start working, you will be able to renegotiate your loans at better rates. That's something I'm aware of. And you just go out in the marketplace, and if you're working and have a good salary, you can do that. So look at the interest rate, look where it is, and make a decision based on that.
So Xavier has sent me a note here. Is there a way to refinance student loans now at lower rates when compared to federal rates that are at 6.8%?
I don't think so, because you're not working. If you're working and you have a good salary, the private lender would come to you and say, okay, I'm with you, and they give you a good rate. But if you're not working at this point, I don't think, and not that you shouldn't look, because I don't know everything.
You don't.
So you can look, but I don't think you will be able to get a good rate until you have a job.
Okay. Can you share a few tips with us on ways to save money these days?
I think we're all doing it automatically because we're not going out. I mean, I don't know about that would be an interesting poll, but I'm finding that by just the restrictions on life, that I'm not spending nearly what I used to spend. My credit card bills have gone way down, and use this. I mean, they say that people are going to learn to spend less because of this.
Mm-hmm.
Meaning they're going to find that, gee, you know, I can cut. I mean, in my case, I can cut my own hair once I get the backwater on the razor, because it's so simple, and I could save $25 a month that way. There's couple of interesting things that I would think of. When you go out to when you're able to go out to restaurants, meet your friends in your apartment with a good bottle of wine, and don't buy it at the restaurant. That will multiply itself, and you'll drink better wine most of the time.
Thank you.
So that's one that I've found that works. Coffee. Don't get into that habit. Meaning, pat yourself on the back because you can afford a $5 or $6 coffee and you buy it every day. Get rid of that. Make it at home and bring it to the office. Or if the office has one, have that coffee. But, you know, those coffee houses are wonderful if you're going to meet a friend and you're going to spend the afternoon and you're drinking a nice coffee and you're savoring it. That's what I mean by enjoy. But if you're doing it route, it's not going to be enjoyable, and it's going to cost a lot of money.
Okay. Natalie wants to know, where should we invest emergency funds? In high yield savings accounts or a Roth IRA?
Well, Roth IRA, I love the idea of a Roth. I mean, I happen to be a big fan of a Roth IRA. But be aware that in order to get it out tax-free, you have to leave it in for 5 years. It is liquid, but you'll pay taxes on the growth. That's not a bad risk. If you build up a Roth, I really like those investments, and I've always, for the clients of mine that were eligible for them, either privately or through their respective 401ks, I've always recommended them. I took a Roth option on my 401k, and glad to have a pile of tax-free money.
What are you thinking about international investments or emerging markets these days?
They've trailed for a long time, and I think they will continue to trail. I like them long-term, but when I say long-term, I mean long-term. Don't look. So if you want to allocate a little bit of your 401 of your assets to international or emerging markets, fine. But just be aware this is not going to happen over a year. I think it will happen, but they're much slower than the US.
Okay. Another question from a little while back. What do you think of the impact of printing money today for stimulus and unemployment will have on the value of the dollar?
Well, again, it's the same inflation question.
Right.
And I think it will occur. I don't think it will happen quickly. Meaning, I think it's going to happen down the line.
And what about life insurance?
Okay, life insurance is based on need. And good question. And what damage would happen by your passing? If you're married with 2 children who are in school age, that is a big need. I think you have to look at it, how can I put it? Intellectually, and use reason and say, what would be the economic cost of my death? And then buy the insurance based on that. I hope that answered your question.
Thank you. We have another question about retirement strategies from a relatively young graduate in his 20s.
Okay.
Should you be thinking about retirement at this time?
Well, in other words, if you have the ability, what are your abilities? That's a question. How much can you put away? I think the Roth is your first vehicle because it could be a great retirement fund, but if you need a down payment 10 years down the road, you can dip into that. And you can pull out your principal and leave the growth to go on. If you start now and you're in your 20s and you can live on 90% of your income and invest 10%, you will live a very happy life financially. You'll be very comfortable. As long as you don't make big mistakes, whatever strategy you use will work, but that is the magic number that works.
I recall when I graduated from college, I was told that rent should consist of less than 50%, or something closer to like 25%
Right.
of your total expenses. Is there a model for that in New York City in 2020?
Oh, gee. I mean, we're living in just not the worst, but close to it, real estate market there is in terms of expense of people starting out. And you have my empathy. As far I was in the midst of a recession, so I got to rent very easily when I was younger. I don't know what the right amount is. I go back to saying, can you save 10% of that income? And what do you need to enjoy your life? That's the second. And if what's left is your rent, okay.
And can you share with us a little bit about, these questions are all across the board about how to manage one's money in terms of your integration of mindfulness. Is it really about taking that pause before you make these
Absolutely
moves?
Absolutely. There's instincts. I remember when I can actually remember when an impulse came and I was actually able to stop it when Bear Stearns was going down. The stock, which had been in the 50s or 60s, was at 4. And I said, gee, that's cheap. And I said, I'm just not right. I thought about it. They went bust on Monday. That was on Friday, and they went bust on Monday. Luck and good delay. Yes, always pause, always think it through. Whatever you're doing, whether you're working with an advisor or you're doing it yourself and you're going into different strategies, be mindful. In other words, am I acting on fear and am I acting on greed? Those are the 2 questions that I ask myself, and I think everybody would be well, because those are the two attitudes that cause people to make very big mistakes.
So we have another question, which is there any platform that you recommend for trading or investing? Sometimes folks don't have the minimum for an investment advisor.
Yes, when you do, my strong recommendation, if you don't have enough money for an investment advisor, go to Vanguard, go to Fidelity, go to any of the big holders of index funds, State Street, iShares, open up an account with them direct and build your indexing. So no, I think they're because of regulations, advisors keep, and the load that they've been put under, they're keeping, I kept increasing my minimums because the amount of work that had to be done for an account just kept growing. So yes, if you're a beginning investor, my strong suggestion to you, buy index funds, buy from one of the big, buy it from Vanguard, buy it from Fidelity, buy it from Schwab. Doesn't matter. They're all, an index fund is an index fund. The differences aren't going to make any difference to you. They're very inexpensive. They're very accurate in what they do. For the beginning investor who doesn't have a lot of money, I think that's the right thing to do.
Thank you. I'll just mention that the alumni office has a very informal relationship with an organization called the Financial Gym, which was started by a woman who was a wealth manager, and she felt that the advice that she was given to clients who had to have a minimum of $250,000 to invest should be available to everyone.
Mm-hmm.
So she's created this business, which is membership based. You pay a membership fee every month and get a financial advisor who can talk you through your financial goals, whether it's to buy a house or to build up a nest egg or to launch your own business. And I think they're having a special deal at the moment for folks to join that the Financial Gym. So that's something folks might be interested in exploring.
Good.
We have another question about cryptocurrencies. What are your thoughts?
Long term, they're going to be very good. It's going to be incredibly volatile. So I do have them in my portfolio. I've had them for a while. I think they will, but I don't know the time frame. So I'd be cautious about them. I think financial technology is a growing field. If you look at companies like Square, I'm very concerned about, not concerned, I think the traditional banks are going to have a lot of problems because companies like Square, Venmo, there were online banks. These are very interesting investments that are working and people are using them a lot. So I don't know if you're aware, but the president of Twitter owns significant amount of, I think he also owns Square, but he gave $1 billion to the COVID virus, which actually, I mean, he's wealthy, he's still going to be okay, but it was 28% of his wealth. I was impressed.
Wow.
But I think he also made outrageous profits on Square that he was giving because of the fear of cash. Cash is a tremendous transmitter of germs. So a company like Square, great company. There's a number of financial technology companies that I would look at before I look at cryptocurrency. I think that's coming, but I think it's further down the line.
Sounds good. All right. We are now at 6:58. So Alan, any last thoughts?
No, I thank you all for coming, and I really hope I gave you some help. That's my sincerest desire.
I want to thank you so much, Alan. I also want to thank all of the alumni who signed in tonight and for asking so many great questions and being such an engaged audience. We're going to send a recording of this meeting out in our follow-up email tomorrow, as well as a reading list that Alan has compiled for you that for additional resources that can help you think even more about money and mindfulness over the next few weeks and months. Thank you so much, everyone, for being here. We look forward to seeing you at one of our future upcoming events as well. Next week, we have a panel discussion about alumni who work in the healthcare industry, insights from the front line about COVID-19, which should be interesting. And we'll continue to update you on more career programs in the weeks ahead. So thank you very much for being here, everyone. And we look forward to seeing you at an event soon.
Great. Take care.
Thank you very much.
Thank you, Alan.
Bye-bye.
Good night, everyone. Stay
Good night,
safe,
everybody.
stay well.
You
Go
too.
Bearcats.
Take care.
Take care.